Wall Street is using a secret trick to pump billions into Bitcoin, and most people are being left in the dust. They've created a deceptively simple ETF trap to inject an insane amount of money into the market, and it's the real reason you're seeing these massive price spikes. In this video, I'm going to expose exactly what this trick is, how they do it, and what you need to know to stay ahead of them. Bitcoin began as a fringe idea, a digital currency for people who dreamed of a financial world outside the old system. For most of its life, its market was a wild frontier, populated by individual enthusiasts, early believers, smaller, risk-tolerant traders. Then, in early 2024, everything changed. The titans of finance received regulatory approval to launch the spot Bitcoin Exchange Traded Fund, or ETF. This wasn't just another financial instrument, it was the opening of a massive, previously sealed gateway. It connected the vast ocean of traditional capital to the much smaller contained world of Bitcoin. That connection fundamentally altered the rules of the game for everyone involved. This mechanism, this hidden trick, is what we will explore. The introduction of these ETFs represented more than a new way to buy Bitcoin. It was a signal of legitimacy, a stamp of approval from institutions that had once been skeptical. Suddenly, financial advisors managing retirement accounts, large pension funds responsible for trillions of dollars, conservative institutional investors had a regulated, familiar, and easy way to gain exposure to the asset. They no longer had to worry about setting up digital wallets, managing private keys, navigating the complexities of cryptocurrency exchanges. They could simply buy a share of an ETF, just like a share of a technology company or a commodities fund. This shift created a powerful and predictable new force in the market. Before, price movements were often driven by retail sentiment, speculative trading, macroeconomic news. Now a more structured and relentless pressure began to build. The daily decisions of multi-trillion-dollar asset managers started to matter more than the chatter on social media. The flow of money from these institutions became a primary driver of price action, creating a mechanism that could propel the market upward with rare force and consistency. Understanding this change is crucial for anyone interested in Bitcoin today. So, Wall Street is here. That should be good for everyone, right? More money, more adoption. Here's the crazy part, they aren't playing the same game as you. They invented a new game, one where they have a massive structural advantage. You see these insane price swings, huge, explosive pumps that come from nowhere, followed by brutal crashes. It feels like the market is rigged. There's a machine working behind the scenes and almost no one sees how it works. So, what exactly is a spot Bitcoin ETF? And why is it so powerful? An exchange-traded fund, or ETF, is traded on a stock exchange like a regular stock. An ETF tracks the price of an underlying asset. Could be a basket of stocks, like the S&P 500. Could be a commodity, gold, or in this case, Bitcoin. The key word is spot. A spot ETF must hold the actual physical asset it tracks. No derivatives, no futures. It must buy and hold real Bitcoin. When an investor buys a share of a spot Bitcoin ETF, they give money to the fund manager, who must go to the open market and buy actual Bitcoin. Example, BlackRock's IBIT. Example, Fidelity's FBTC. By late October 2025, assets in these funds surged to nearly $150 billion. On October 28, 2025, U.S. spot ETFs had net inflows of $202.4 million in one day. In early October 2025, a weekly inflow of $355 billion helped push Bitcoin above $126,000. Imagine the entire supply of Bitcoin for sale is water in a bathtub. Wall Street connected a massive fire hose to that tub. That fire hose is the Bitcoin ETF. When institutions allocate, they turn on the fire hose. The water level rises quickly and steadily. The tub's limited size makes it highly sensitive to large inflows. This is the liquidity engine. The 4 steps of the engine. The liquidity engine operates in a clear 4-step feedback loop. Each step feeds the next, driving prices higher with remarkable momentum. Step 1 is the inflow of capital. Pension funds, hedge funds, asset management firms. They allocate by purchasing shares of spot Bitcoin ETFs. This is the trigger. A decision in New York or London translates into multi-million or billion-dollar orders for IBIT, FBTC, ARKB. Step 2 is the mandatory purchase of Bitcoin. Once the ETF receives capital, they are obligated to buy a corresponding amount of actual Bitcoin on the open market. This is not optional. If an ETF gets $100 million in net inflows, they must acquire $100 million worth of Bitcoin. Those coins move into the ETF's custodian vaults, out of active trading supply. Bitcoin has fixed supply, and only a fraction sits for sale on exchanges. Massive, persistent ETF buy orders compete for limited supply. Intense new demand pressing on constrained supply pushes price up. Simple economics. We saw it in early October 2025. 355B weekly inflows, price over $126,000. Rising price generates positive media coverage, creates FOMO, validates institutional decisions, attracts a new wave of capital, and restarts the cycle with even more momentum. One of the most noticeable changes since spot ETFs is how dips behave. In the past, sharp drops could trigger cascading panic and prolonged downturns. Now, many dips appear shorter and shallower, met with strong buying. This isn't an accident, it's a direct consequence of the liquidity engine. As long as daily net flows remain positive, issuers are still required to buy Bitcoin, even in consolidations. That creates a persistent bid, a floor-absorbing selling pressure. Funds like BlackRock's IBIT alone crossed 800,000 BTC. Coins moved to cold storage, out of circulation. They're not sitting on exchanges waiting to be dumped. This is a supply squeeze, less liquid supply, harder for sellers to overwhelm the market. When dips are repeatedly bought, investor psychology shifts. Fear gives way to opportunism. Retail mirrors institutions. A multi-billion-dollar structural buyer provides a psychological backstop. Over time, this contributes to more stable, upward-trending price action. Now, if you want to stay ahead of Wall Street, smash that subscribe button and grab the free weekly ETF Flows newsletter linked in the description. The best part about the liquidity engine, it's not hidden. Because ETFs are regulated, their activity is transparent and publicly reported. Daily fund flows are public data anyone can access. Use SOSO value for detailed daily inflows and outflows across US spot Bitcoin ETFs. Clean charts and tables. Use CoinGlass's dedicated ETF flows section for daily and cumulative figures. Farside Investors publishes concise daily summaries, widely cited, including the 202.4 AM inflow on Oct 28, 2025. You'll see when the engine runs hot, or cools, like the $40.47 outflow on Oct 20, 2025. Tracking flows shifts you from guessing to analyzing. Big inflows imply significant institutional buy pressure. Sustained outflows can warn of price weakness. This isn't certainty, just critical context. Flows are the fuel gauge of the engine powering price. Educate yourself. Understand the 4 steps. Track flows daily. Use flows to build a resilient strategy. Align with institutional trends, not emotions. Remember, macro, regulation, and sentiment still matter. Manage risk, never overextend. The pipeline can fuel growth, but institutional shifts can cut both ways. The process is no longer a mystery. You can see the fire hose turning on and off. What do you think happens when sovereign wealth funds and major pensions put just 1% through this engine? Drop your price prediction in the comments. Like, Verstainsbezan, aber de Bein. Subscribe. Unpushgebein de Verstan, Versdannent. And turn on notifications so you don't miss the next breakdown. Wall Street's #1 trick is a brilliant financial engine. Don't watch the price, watch the flows.